Last year, I watched a mate lose out on $200,000 because he was waiting for the right time to buy a property. He kept saying, "I'll invest when the market's better." Well, while he was waiting, the market moved on without him. My friend's not alone in this dilemma. In fact, his story highlights a challenge that countless property investors are facing right now. It's been hard to miss all the chatter about interest rates and economic uncertainty lately. One day, experts say we'll see multiple rate cuts by the end of the year. The next, they tell us maybe just one cut by November. Then they change their tune again, saying we might not see any cuts until late next year. The truth is that even the RBA have no idea when inflation will settle down enough for rate cuts. Meanwhile, property investors are stuck in this endless debate. Buy now or wait for things to look better. And it's not a new thing. Investors have always been on the hunt for a better deal. But here's the thing, maybe we're asking ourselves the wrong question. Instead of getting caught up in all the gloomy headlines or trying to perfectly time the market, which, let's face it, is nearly impossible, there's one key idea that can help guide our property investment decisions even when everything seems up in the air: market cycles. You might have heard this term get thrown around, but what does it actually mean for a property investor? If you've been involved in property for a while, you've probably seen this play out. Property values in an area go up, more people start buying, and then suddenly prices drop before they start climbing again. It happens over and over. Now, these ups and downs aren't a bad thing. They're just part of how the market works. It's about supply and demand. The property market cycle is basically a pattern that keeps repeating. Property values and market activity go up and down. It's not just about supply and demand though. Things like regulations and development constraints also play a part. There are four main stages in this cycle. First, there's the boom. This is when everyone's talking about a particular area or type of property, interest rates are low, values are increasing quickly, and properties are selling fast. Then comes the slowdown. People start to lose interest, there are suddenly more properties available than buyers, and prices start to look a bit high. After that, we hit the slump. Things settle down, prices drop, and you'll often see more buyers than sellers. Finally, then there's the recovery. Investors start coming back, prices begin to rise again, and properties become less available. Understanding these stages can be really helpful. It gives you an idea when the market's at its lowest point or when it might be getting too heated. This knowledge can help you make better decisions about when to buy or sell. And remember, what's happened in the past often influences future prices. So getting familiar with these cycles can give you a better sense of where the market might be heading. Now that we understand market cycles, let's look at where you are right now. You might think the whole country follows one big property cycle, but it's not that simple. Each city, even different suburbs, have their own cycles. It's pretty interesting when you look at the numbers. In the last year, Hobart's property values dropped a tiny bit, while Perth shot up over 23%. Brisbane wasn't far behind at 16%. These differences show up every month to month. In June, Perth values went up nearly 2%, but Melbourne actually dropped a bit. It's like each city is dancing to its own tune. There's even what experts call a ripple effect within states. The fancy, expensive suburbs usually change first. Then it spreads out to the cheaper areas, and finally to regional spots. To figure out where we are in the cycle, we often look at how property values change over 3 months. It's a good way to spot which areas are doing well and which areas are struggling. With that said, let's take a quick tour around the country. Let's start with Sydney. Property values here have gone up 6.3% over the last year, but things are slowing down a bit. Last month, growth was only at 0.5%, which is 4 times slower than Perth. Even though prices are at an all-time high, experts reckon they could hit 1.9 million by 2027. That's pretty wild. The market's so expensive now, medium house prices are over 1.4 million, that only the wealthiest can really get in. Moving on to Melbourne. This city's been a top performer for ages. House prices have grown by 591% since June 1992. But right now, it's in a bit of a slump. Growth has pretty much stopped, and Melbourne's seeing the least growth of all capital cities. It goes to show you how important it is to pay attention to market cycles, not just past performance. If you jumped on the Melbourne bandwagon because of its history, you'd be about $100,000 worse off than if you'd caught Perth's rising market last year. Now, it's been a bit of a roller coaster in Brisbane. After not much happening in 2020, prices shot up in 2021, peaking at around 30% growth. There was a bit of a downturn after that, but since June 2023, things are looking up again. Values have grown by 15.8%, hitting a record high of $859,000. Things are on the up in Adelaide too. 1.7% growth in the last month, 4.7% over the quarter, and 15.4% over the year. A lot of investors who can't afford Sydney or Melbourne are looking here for better deals. But there's not enough supply to meet demand. New listings are down 1.3% and total stock is 17.2% lower than last year. More buyers are pushing prices up, sales are up 6.7%. It's definitely a seller's market right now. Interestingly, unit values have actually dropped 1.2% over the year. The star performer right now is Perth. Prices have shot up by 23.6% over the year and don't look to be slowing down. There's way more demand than supply, which could push prices up another 8 to 11% next year, maybe even 25% by 2025. Compared to last July, there are about 22% fewer properties available to buy. Moving on to Darwin and Canberra. These two are in a similar boat, which is why I'm grouping them together. Almost no growth in the last month and about 2% over the year. They're both recovering from negative growth in 2023, but Canberra had a bigger dip. Darwin's the cheapest capital city with a median house price of $504,000, but that's still 5.7% below its 2014 peak. There's not much opportunity for growth right now. In Darwin, high rents are slowing the market down and unit values have dropped 17.1% in the past year. Canberra is expensive with a median value of $870,000 and hasn't seen much growth lately. High interest rates are making it hard for people to borrow money, especially given how pricey it is to buy in. The market seems to be in recovery mode and things might pick up if interest rates come down. The strong job market, especially in government, should keep demand fairly steady. And lastly, we have Hobart. This is the only city where values have actually dropped, down 0.1% over the year. If you bought at the peak in March 2022, your property might be worth 11.7% less now. Unlike other cities, there's actually more stock available in Hobart, 29% more than last year, which is keeping prices down. Experts think we might see a small increase of 2 to 3% next year, but it's going to be slow and steady at best. So this analysis leads me to the big debate in property investing. Is it better to time the market perfectly or just get in and stay in? You've probably seen those flashy headlines about the best time to buy a property. They pop up every time the RBA changes interest rates or there's a new population forecast. It's pretty tempting to try and pick the perfect moment to jump in, right? But here's the thing. This obsession with timing can actually keep you out of the market for years. You might end up waiting and waiting for that perfect moment that never comes. And let's be honest, predicting economic cycles accurately is a tough job even for the experts. So what's the cost of all this waiting? How long should you hold off before buying? And really, how good can the average investor or even an expert be at predicting these cycles to maximize short-term growth? There's a famous story about Warren Buffett that really puts this into perspective. He bet $1 million that simply staying in the market for 10 years would beat any expert trying to time the market for short-term gains. And guess what? He won. By 2017, his investment had grown by 125.8%, while the best fund manager only managed 36.3%. Now, Buffett was talking about the stock market, but the lesson applies to property too. Even the pros find it hard to time the market perfectly. There are just too many factors at play. Don't get me wrong, timing does matter. Buying when prices are at the absolute peak isn't a great idea, but in the long run, time in the market is what really counts. And I'll tell you what's really interesting. If you look at the Australian property market, prices over the last 30 years have always gone up in the long term. Even with the economic ups and downs we've had, the dot-com bubble in 2000, the GFC in 2007, COVID-19, property values have climbed over time. So while it's tempting to try to outsmart the market, history shows us that getting in and staying in is often the smartest move. And now, some food for thought. Market uncertainty can actually be a golden opportunity. I know that might seem counterintuitive, but hear me out. When the market's uncertain, most people get scared. They sit on the fence waiting for a clear sign that it's safe to invest. But here's the thing, by the time that signal comes, you've often missed the boat. Take Perth, for example. If you'd bought there between June 2023 and now, your property would have grown 23.6%. But if you're buying today, you're probably looking at around 8 to 11% growth over the next year. Those early birds who got in definitely got the worm. They'll be 26.2% better off. See, these uncertain times can be a gold mine if you're smart about it. While everyone else is hesitating, you could be snagging properties that will be in high demand when the market picks up again. It's not just about immediate gains either. Buying during certain market cycles can set you up for future benefits. Rising demand, higher rents, the works. Look at Darwin. Even though growth has been flat lately, owners are holding onto their properties. They're down 14% since last year. They're playing a long game, expecting for things to turn around. Now, interest rates are still putting some investors off, but inflation's come down from its peak of 7.8% in December 2022 to 3.6% now. The RBA hasn't committed to cutting rates yet, but it'll happen eventually. When it does, investors who position themselves well will be sitting pretty, enjoying rental growth and paying less in interest. Here's something to remember. A market that goes up and down isn't unhealthy. It's actually a sign of a healthy market. Despite all the differences between the location, property prices have generally gone up by around 7% each year over the past decade. And here's the key point. Past performance isn't a good indicator of future performance. Prices tend to even out over time. So buying in areas that have underperformed in the last could be smart. You're banking on those prices catching up eventually. Of course, all of this comes down to you knowing yourself and your risk tolerance. You've got to be able to stomach the uncertainty and look past the dramatic headlines about market crashes and booms. So, buy now or wait? The answer to this question is always the same. Always a good time to buy, and it's always a bad time to buy. The defining factor for investment success lies in the underlying fundamentals, the current market cycle, where to buy, and consistent time in the market. See you next video, guys.